So tell me a little bit about the difference between, when people hear M&A advisor,
Sure.
they often conflate it with a business broker.
Right.
So let's kind of start there. What's the difference between a business broker that sells someone's business and an M&A advisor that helps someone sell their business?
Mm-hmm. A lot of people use these terms interchangeably. A lot of people use them with different meanings. In reality, it breaks down to your fee structure, in my opinion, and your level of service. What services you're offering. So typically when somebody says broker, they're talking about somebody who charges a larger fee on a percentage basis. Like you mentioned to me, a 10% fee. So that's a very common broker fee structure. And somebody who might just offer a limited service offering to their clients, like they offer to do a listing and maybe they do an abbreviated overview of the business, but they don't go into a confidential memorandum. They don't provide a detailed and tailored sell side process. They don't run an auction or a bid process. So it's really just a listing of the business. When you're talking about lower middle market investment bankers, you're talking about somebody who has a tailored process, typically runs an auction or a negotiated process based on the client's objectives, and isn't just listing the business. And again, a banker's fees will also differ depending on their business model. And bankers can have varying business models depending on their clientele, depending on their industry experience or their focus on industry. But typically it's a different fee structure from a broker. So many times a client can find perhaps a more advantageous fee structure from a banker than maybe just from a broker who works with a large number of listings and just, works on the basis of doing listings rather than full sell-side advisory.
Would it be self to say if I were to oversimplify this, okay? And
Sure.
I apologize to everybody out there.
All
I'm going to oversimplify this, but a business broker, they're more or less charging a commission to sell the business. They're listing it like maybe a real estate transaction, right? They get the listing, they put it online, buyers are out there and they're going to get paid a commission, let's say in this case 10%, versus an M&A advisor, they're charging fees because they're doing more advisory work. They're actually giving advice, not just listing it. Sure, there might be some quote unquote advice, just like in a real estate transaction, right? The real estate agent may give their opinion on, hey, if you do this, then that might happen. But more or less, a broker is getting a commission, whereas a M&A advisor is doing advisory work. And fees are, even though they're a percentage of a transaction, right? There's a lot more that entails in that. So walk me through a process of what a sell-side M&A process may look like. So somebody, you mentioned lower middle market. And so walk me through how somebody who's ready to sell, and whether they're working with an advisor, maybe they're on their own, they come to you and they say, hey, we want to exit. What does that process look like? Just kind of walk us through the steps.
Every business is different. Of course, I've got to say that as a blanket statement.
Sure.
Everybody's timing and process is different. The key, and I'm sure you work with clients all the time on this, Avo, a key piece of it is that preparation work. So getting all of your data together, making sure your business, has been performing at the level you want it to achieve your transaction outcomes, to achieve your objectives. So you got to get all your data together, and then you're going to want to speak to an advisor. Typically, I like to see clients or prospects work with an advisor in evaluating the banker or the broker they engage. Because that way, as a banker that is evaluating a client engagement, I know that I can get the information needed. I can get the data and documents I need to properly provide a proposal for my services. So that client ideally either works with somebody who they believe in their organization, whether that's a CFO or a controller that can help them be prepared. Ideally, they work with an outside advisor to help them get ready to evaluate bankers for their sell-side engagement. And so that's kind of the first part of the process, is the preparation part. I also recommend that prospective clients of bankers get a third-party appraisal. Many times, like I work with independent firms, and I'll help a prospect get a third-party appraisal or valuation of their business as part of my process. But that advisor who works with the prospective client can also, help that client to get a third-party appraisal so that they're better equipped to approach bankers or brokers in a process. The next step, of course, is approaching bankers and evaluating their business models and evaluating how they sell you on their process that they take a business through. And so you'll want to meet with at least 3 different bankers or brokers, get their proposals, and evaluate that against your transaction objectives that you've determined yourself in order to choose, what engagement, what service provider to go through, what banker to go through. Once you've done that, the actual engagement begins, right? So you've got the data gathering phase, you've got the we call it pre-marketing in investment banking, and that process can take anywhere from 2 weeks if you're absolutely on the button, all the way up to 3 months, a quarter, and it just kind of depends on the preparedness of the business. It depends on the level of research needed for that particular engagement, the industry you're in, and what's required to go to market based on the client's business, the timing of the business, the recent performance of the business, as well as what are the quality of the documents, the documentation and the history of the business. And so from that period, you will, once prepared, you have your marketing materials, you have your executive summary, a confidential memorandum prepared, you're ready to go to market. Then you enter a marketing phase. So that phase of the business, once you decide you've determined the buyers, the prospective buyers you're going to approach for this client, and you've initiated the marketing, that process can take anywhere from, I like to say 3 to 6 months. That's can be a little bit shorter if you're, absolutely prepared and the market demand is high and, depending on timing of many factors, but 3 to 6 months for a marketing period, all the way through signing a letter of intent, is a pretty good estimate. So once you go through marketing the business and you've determined, the letter of intents that you have received, the proposals from prospective parties you've received, you then can evaluate those with your advisor. As you're in, an advisor maybe who isn't your banker as well as your banker can help you evaluate all the different proposals and whether you and which prospective buyer you choose and how to counter that offer if necessary. And then once going under letter of intent, you start the due diligence phase up until close. And, that we like to see, 60 or 45 days on due diligence. We could see it go faster potentially, but we think that's a pretty good period of time for appropriate due diligence, which we like to see, buyers perform on our clients. But that can depend on various factors, changes in business, a lot of change in the market going on right now. I'm sure, Jack, you've seen some, diligence times get extended recently, perhaps. But that would pretty much, be a full process if everything goes well with kind of some timing estimates in there.
Yeah. Now, you mentioned along this very long process where there's a phase where you put the marketing deck together and you take it to buyers, right. Potential buyers, you call them. And I guess that's one of the biggest distinctions between an M&A advisor versus a right. business broker, where they, the business broker, again, I'm oversimplifying, they list the business, right. Whereas an M&A advisor knows who to call.
Right.
Right. Talk to me a little bit more about that process of knowing who to call, who are the different actors, who are the different buyers, and the level of understanding that you as an M&A advisor need to know about those potential buyers that is not apparent to, everyday person looking to sell their business.
Absolutely. And so that's a big differentiator, right, as you're bringing up, Avo. So when you're contacting prospective buyers and you're putting them through a process, right? This is not, as you said, a listing where somebody has an opportunity to respond to an individual listing. This is a process where you're marketing to a list of prospective buyers, and you're soliciting their feedback and their participation in a process in order to develop a competitive bid And so that's a very key difference. Knowledge of the buyers, as you said, is very important too. So when we go out to market, we know things like, very typically our clients are add-ons for private equity firms. So private equity firms that are a very typical buyer in our process, we will have the knowledge of, if we believe our client's business relates to their existing investments, we will know, okay, this private equity group has a platform investment. They are 4 years into their investment, and they typically do a 5 to 7 year hold, as well as we will know that they've deployed 60% of the capital out of the fund that's investing in this platform. And so when we go to speak to that buyer, we come to the table for our clients having that knowledge about each and every party, maybe not every party, but a good number of the parties that we think are high level prospects for investing in this business or buying this client. So that's a very different approach than just allowing those parties to respond to a listing.
Yeah, I mean, and that's so important. I mean, we run into all the time. That's one of the first questions a seller should ask the other side and look into is, does the buyer have the funds to close? And if they don't, then you're going to start spending a lot of money racing to a finish line and then realize that the buyer didn't even have the money to get it done in the first place. So, having that information and that market knowledge to be able to provide to a client that, yeah, we know they have the funds, we've seen it deployed, is a huge value add.
Yep.
Yeah. So another thing you said, which caught my ear, was early on in the process, you're advocating for the seller and their advisor to sit there and basically interview potential M&A advisors.
Exactly.
And because, from my perspective, if I have a client that we're planning for an exit, ultimately what we care about is how much money they're going to end up in their pocket. Now, obviously, there's some other considerations like the legacy that they want to leave, what kind of successor they want. But at the end of the day, I don't care what the selling price is. I care about how much is left over. And I want to know how fast you could sell it. Who's the potential buyer? What do you think the pricing's going to be, when ultimately how much you think we're going to end up with? So in your advocating for that process, what should an advisor such as myself working with a client, what should we do? Should we call up different M&A firms? Is it the firm that matters? Is it the individual working there? Because you have these firms, they have multiple partners, but not all is the same just because they're with a firm. So what do you suggest that advisors and clients alike do or go about finding and interviewing the right M&A advisor?
Sure. I would speak with at least 3 different banks or brokers. You could go with either. They will have very different business models, as we discussed, but you want to focus on the person that you're interviewing more than you want to focus on the firm. They may have some great experience and they may have a hall covered in tombstones, as they all do. But you really want to focus on who you're hiring individually. You want to trust that person. You want to understand their experience and their knowledge. You want to ask them who is on the team. You want to be able to point to specific individuals, who's doing the analysis work, who's doing the marketing work, who's talking to buyers. They should be able to answer those questions for you. And if they don't, you may want to consider that in your appraisal of them. You want to ask them, how are we going to market my business? They should be able, even though they don't have all the details in this part of where you're just evaluating each other for this engagement, they should be able to talk intelligently about, here's how I will market your business. Here's my experience in this industry or in this niche within the industry, or businesses who sell the same way or similar customers, how we've positioned businesses before. You want to talk specifically about marketing and positioning and get responses that you believe are appropriate for your business before selecting that advisor. Those are things that oftentimes are kind of pushed until after the engagement letter is signed. And I think those are much better handled and much better ways to evaluate your advisor if you bring those before you sign the letter and you start talking about, how are we going to do this? Let's talk about, once this is signed, how are we going to market? What's the process? How do you put together these materials? So I think that shines a lot of light on how your engagement's going to go.
Right. And once you engage a broker and an advisor, you're exclusive with them. It's like when you sign up a real estate agent, and there's this expectation that during that time period of the engagement, whether you close with the help of this advisor or not, he's going to be entitled to some fee. So yeah, I think that's great advice. I mean, understand the process before you sign the dotted line and go exclusive with somebody. Make sure you understand the process. It's like going steady with the girlfriend or boyfriend or whatever. You probably want to meet some of the friends, understand where they're thinking before all of a sudden you get serious, you know.
Where are you going to take me to dinner?
Yeah,
what are we going to do? What movie are we seeing?
Yeah,
No,
exactly.
Right. Well, let's talk a little bit about valuations.
Sure.
You talked about getting an appraisal, and we've had a guest here who's an ASA designation, does valuations, and we've talked to him about this as well. But there's different levels of valuations, right? So, for example, a CPA, maybe they could do some discounted cash flow models using Excel, and they could say, "Hey, we think this is how much it's worth." I have some valuation tools that I use, but it's not for to present to the IRS for valuation discounts, right? It's more for us to get a basic idea of what the business may be worth. And then there is also what the business owner thinks her business is worth, right? And we could have huge dispersion between the extremes. And so when somebody comes to you and they say, "Hey, we think my company's worth $10 million. Right? And CPA says, "Well, we think it's 7.5, but I'm going to make the argument we should sell it for 10. They come to you and they say, "Well, how much do you think we could sell it for?" How do you go about tempering expectations and setting realities? What does that look like? Because a lot of times, closely held private business, this is their puppy. They've built this thing. They're emotionally connected to this thing, and it's really hard for them to hear, "Look, your company's not worth 10. Okay, let's be real here." And especially in this economic time, we got credit tightening, right? A few years ago, M&A bonanza.
Yep.
Now credit's tightening. I think companies that are sellable companies in any market, they're going to demand a premium. Yep. And other companies that will only sell in rising tides, they're going to be worth their true worth, if not at a discount.
Right.
So how do you bridge that gap between what somebody thinks it's worth and what you think you could sell it for?
Yeah, it's a great question. I think in general, excuse me, more data points are better. I think I'm lucky enough running our firm and our practice that we can be very selective in how we engage clients. And so we like to encourage clients to get those other points of view. And then we have our own valuation that we run through, and we give a transaction valuation, a range of values that we show to a client. It is not traditional appraiser's valuation or CPA valuation. So it's not, choosing one of the four methods or blending the four. What we do is a willing buyer, willing seller method. And we look at return on equity based on a transaction, looking at the financeable collateral of the business, putting on debt on the business, and looking at the return on equity for potential buyers. And so in general, I just think it's best to get as many data points as you can, or at least several data points. And then you go in with not only your expectation, you've got a qualified advisor a great advisor with a lot of experience providing you with their valuation. You've got your broker's opinion. You might have a certified valuation from a third party, and you can decide whether it's worth, getting the $50,000 valuation or the, $5,000 valuation. There's some out there even less than that. But in short, I think it's best to get more data points from more viewpoints or perspectives that you would think are valid. A certified valuation providers, somebody who regularly evaluates businesses, provides valuations to clients, and then, of course, a broker's opinion, who would be somebody who's working with buyers, closing transactions regularly.
Yeah.
So
Yeah, I mean, I've seen, and I'm interested in hear you speak to this, is in a lot of deals, it seems like things are starting to really come together, and then all of a sudden someone pops in and says, well, we got our quality of earnings back. And all of a sudden the price isn't making much sense. Can you speak to a little bit about what quality of earnings reports are, and what they hope to achieve, and how they and when they should be obtained?
yes, more and more, Jack, I think you may have experienced clients doing this. More and more sellers are performing a sell side quality of earnings prior to going to market, and that would be an absolutely ideal situation. I don't believe that every business model calls for it. So there are certain businesses that don't, if they have the appropriate accounting policies and bookkeeping in place from an early stage, you are able to kind of assess that risk. And, we can kind of look at that from a high level standpoint, and we can work with some other CPAs and advisors we work with to assess, do we need a quality of earnings given this business model, given the accounting policies and procedures that we have, what would be the recommendation here for this business? That said, it is something that can be very constructive. And if you can find one that is appropriately sized and scoped and priced for your engagement and for the expected transaction size, it's a great exercise to go through on the front end. You eliminate a lot of surprises, like you said, Jack, that you could have going through the process, things that might derail it if you don't know before. So, if you've got a transaction that's going to be certainly 10 million plus, I think it's a great time, and there are enough quality service providers out there to consider doing that prior to going to market, rather than experiencing the pain during the due diligence,
Right.
And something like that.
Yeah, I mean, this is true with a lot of lower middle market businesses. Usually it's the tax accounting kind of drives the accounting, and
Right.
that's all they kind of do is enough to honestly fill out their tax return the best they can. And when you're looking at when private equity buyers come in, or sophisticated financial buyers come in, they're looking at a lot more than do you properly pay your taxes. and that's where those quality of earnings surprises or values can be really important. So you're not spending a bunch of money thinking you're selling for X, and then all of a sudden you realize that price isn't realistic anymore.
Yeah. I want to talk about staffing the team. Okay. Earlier we were talking about who's going to be on this team at the M&A firm. Mm-hmm. And Jack, we often ask in legal matters, how are you staffing this, right? Because we don't want to keep paying partner fees if you could put a junior person on there.
Right.
But in an exit like this, it's not just the staffing at the law firm or at the M&A firm, but it's also the team that comes together. So for example, if I have a client that we've been planning an exit and we're ready, and now I've been tasked with, okay, I will go and build the team. Who are we involving here? We're going to go interview the law firms. We're going to interview the M&A team. That dynamic, it could get a little patchy because somebody's going to have to be the quote unquote quarterback. And some folks, they don't like that. They want their own teams. Mm-hmm. What's the best approach, in your opinion, that a seller should go through in making sure that the team that's been assembled is working all on their side rather than, everybody pulling in different directions?
It's a great question, Avo. And the reason I think it's so appropriate is it depends. the great, hedge answer. But I know attorneys love to say it depends.
That's what JD stands for. Just depends.
It just depends.
That's right.
So I have seen across the board both teams that are well coordinated and work very well together, and then I've seen, law firms step out of their place. I've seen M&A firms step out of their place in the process. The earlier that you can get everyone acquainted, the earlier you can have a call to discuss roles and responsibilities, the better. There is no one, in my opinion, in my experience, there's no one size fits all in terms of saying quarterback's the managing director at the M&A firm, or the quarterback's the partner at the law firm and they're running the whole thing. It's more talking about, for this engagement, what are the roles? When we're, are we doing a auction process? Are we doing a bid process? Are we negotiating between two parties? What is the engagement here? And then we've got to determine roles and responsibilities. But the earlier you can do that, I think the better. Would you agree with that?
Yeah, no, completely. I mean, you don't want to be in the middle of the process and realize your advisors aren't communicating with each other or don't like to communicate with each other, because people have different incentives in the process. People have different communication styles. People have different expectations about when things will happen and when things will close. And along that process, you'll have surprises thrown in as well. And people have to be understanding and patient and communicate with each other to make sure everybody's kind of rowing in the same direction or marching in the same direction. Because when you go into what I've found is when you go into a negotiation, and if all your people are aligned, you're going to win that negotiation. There's nobody that the other side could pick off and say, let's go after the lawyer. It seems like he's on his heels. Let's go after the advisor. He's the easy guy to talk to. If you're all aligned, then you have to face, the whole army. Right. And I found in certain deals where they'll be like, oh, don't call Jack. He's going to be tough on them. Let's keep him out of this conversation.
Right.
And then all of a sudden, me and the broker maybe aren't aligned, because all of a sudden I'm left out of a conversation. To protect the client I should have really been in, and vice versa. So when I'm on deals, I try to make sure we're communicating, and if the earlier the better, you can develop a relationship among all your advisors. It's going to pay dividends down the road.
Yeah, collaboration's key there. You mentioned bid process and auction process. So I know what those are, but for clarity purposes for everybody else, because this might be the first time they're hearing this.
Sure.
What are those two different ways of selling a business?
Well, auction process is basically going out to a list of parties and soliciting, across all the buyers, their proposals, indications of interest. Typically, we do a two-step process. So we'll go market the business and then give the buyers a letter that details the process that we're going through, a deadline for the indications of interest, and then timing for a letter of intent. Once we get all of those indications of interest, we'll review those with the client, determine which parties we want to select to go to the next stage of putting together a full letter of intent with detailed structuring of the transaction, and then we'll go on to that next stage. Other processes, you say bid processes, but really just anything short of an auction tends to be more of a tailored process. So whether you're going to just a short list of 2 to 3 buyers or you're going to one party, that changes the entire posture and the way you want to approach those potential buyers. So it just kind of depends. Are we doing an auction process where we go out to a large amount of parties and put them through a 2-step system, or are we doing this in a tailored fashion where we're going to approach perhaps a most likely buyer and then some backup buyers, or just negotiate with one party? Yeah. And you want to decide all that up front, of course, not just, go in and determine what you're going to do after you've already started approaching buyers.
And Ps love no bid deals, right? Where they're just the only one.
They all have proproprietary no bid deals.
It's amazing, right? So speaking of Ps and what's happening with the the economy and what we're anticipating tightening of credit, what's going on out there in the M&A world with this liquidity issue that we're going to have moving forward?
So every investment bank, if you're talking about Q1 2023, every investment bank's going to have their own experience and their own sort of data point to take with a grain of salt. What the official research sources say is all data for Q4. So Q4, we had about a 10% pullback. So it's slowing, and everybody seems to think, that's all due to rising rates and increased borrowing costs, lessening of lending based on cash flow for businesses. Everything we're kind of seeing in the debt markets. Q1, we closed a transaction Q1. So our experience is a little bit not seeing as much of necessarily a pullback in activity, though I think there is some of that. But really the biggest change I've seen in Q1 is kind of the types of buyers that are more active and aggressive.
Okay.
So private equity is still out there. They've still got funds. They've still got platforms to add to and all that. But, and I, still deal with private equity guys leaving 10 voicemails a day. Get calls like I have for years, kind of at the same level, but more and more the search funds, the independent sponsors, those guys are more active and aggressive and providing kind of competitive bids to our processes that we're seeing now in Q1. Now, again, that's just kind of our experience. I like these research sources like GF Data. There's a few of them, PitchBook. You can look back, but they're always kind of a quarter behind. So you're not gonna be able to gauge Q1 until we're, close to June. So it's fluid and changing. I think the biggest thing I can point to of what we've seen specifically and personally is kind of the change in who are the most aggressive buyers in the market? Who are the most loud, looking for deals, most active in the market?
So you're saying what you're seeing at least right now, anecdotally, the independent sponsors are being more aggressive
on a relative basis to PE, who's been, I think, after Q4 a little bit more. It's not that they're not investing and not active. It's just I think they're underwriting their bids a little more cautiously.
Why do you think that is?
I mean, the rising interest rates. It's that, and I think.
Why isn't that impacting the independent sponsor? The same rising interest rates, the way it's impacting PE.
I think independent sponsors, search funds, their ability to look longer term, their ability to, the fact that they want to get into the business, that's going to be that business that makes where they spend their time, their next stage of their career, where they put all their time. They are a little more motivated than these funds that are maybe 4 years into a fund, and have to decide, do we do our 8th add-on or do we, batten down the hatches and wait to exit in another year? Or, do we go for the big add-ons or do we just do a couple more small ones? Right. They're kind of redetermining their business model as it pertains to those funds and those platforms.
Yeah, and the reason I asked that question is because I think it just goes to show you why an M&A advisor that understands the different types of buyers is so important.
Yep.
Right.
Because what one person's going to value your company is completely different than somebody else, and having the knowledge of, knowing where to go is so important. And Jack, are you guys seeing on your side any kind of slowdown or any kind of the similarities in PEs versus independent sponsors or different types of people? I know a few years ago we were talking about how they're just crazily overpaying everything.
Yeah, I mean, last year was a very hot year, especially the second half of the year. I mean, it was pretty wild. And then, I think I've kind of experienced a similar thing. It's some tapering, not so much of a rush, to get something done is kind of the attitude. So it's just not kind of flaming hot, but there's still like a healthy attitude that people want to have deals and do good deals.
Yeah, still a ton of dry powder out there, right?
Yeah, that's always one of my favorite slides to educate business owners on the M&A market is that PitchBook puts out this great chart, and it's the private equity capital overhang. And it just shows, the SEC disclosed funds by year and how much that could build up over time. And you show it back to like 2010, and you show how those annual vintages of capital raised just continue to compound on each other, and just, private equity overhang. And It's the veritable dry powder analysis of how much capital is out there waiting to be deployed, just in SEC disclosures.
Yeah.
And so it's pretty powerful.
Yeah, well, we could talk about this all day, guys. I got a couple of M&A guys in here. This is fun stuff. But with the limited time we have left, I want to pivot to think about a business owner right now who maybe missed the boat on selling their business because they waited too long. And the economic cycles, they peak and they trough. And, it's interesting because, if you had asked me 5 years ago, I'd say, oh, we're coming towards the end. And it just kept going and going and going. But it seems like we've hit the crest. So what do you say to that business owner that says, you know what, I missed the boat, and can I really wait another 5 years or 3 years, and who knows when that next high point's going to be to exit? What do you say to them if they're thinking that they might be in between, I have to exit to I'd like to exit, kind of in that middle area? Because if you need to exit, you're exiting, doesn't matter. And if you have no desire to exit, you could wait a long time, you're fine. But that person that's in the middle, what do you tell them right now?
It's a great question, Avo. So as I'm sure you're both more of an expert in this than I am, there are, and I hate to lead with this as a reason, but it's very important. There are estate tax laws that are going to sunset in the next few years that I'm sure you're both very familiar with, that may have a significant impact on sellers, business owners looking to pass down their wealth to their children or grandchildren. So that's the first one to consider, is get good advice from a tax advisor on estate tax, and look at that piece. Look at the estate tax before you even look at the business valuation and your transaction objectives. Talk to somebody who knows what they're talking about. Work with business owners who have sold and done estate tax planning, and talk to them about what the environment is right now and what you should be thinking about. Now, I don't mean that to be the only influence on should I sell my business or not, but that's an important one that's sometimes investment bankers, sometimes other advisors who work in M&A don't like to focus on. And I like to think that's very critical for a business owner to consider. Next, you want to focus on that valuation and data gathering piece. You want to get together with your advisor, put together all that information, and start to get those valuations. Get that independent opinion, get a broker's opinion, and you don't even have to do this while you're deciding to hire someone. You can go out and get a broker's opinion, my opinion, a banker's opinion, and use that as part of your planning process. You don't have to be, hey, let's sign an engagement letter. At least I like to work with prospective clients, on no obligation basis. We don't have to make this an engagement discussion. This is just a opinion discussion.
Right.
And so you need to take all that information, your valuation, your transaction objectives that you're developing yourself with maybe a non-transaction advisor, and consider that along with the estate tax piece, and really be educated when you approach the table starting to discuss an engagement. So way before you do all that, have that planning discussion phase where you take your estate tax considerations, you take your valuation and transaction objectives, and consider them before saying, hey, I'm going out to hire this week or this day. I think the most sophisticated sellers do that, and they can much better gauge, hey, am I a seller in 6 months? Am I a seller in a year, based on the performance of my business, based on my opinion from my broker, based on my valuation from a certified valuation appraiser. And you're much better equipped to say, am I ready to engage someone to represent my business, or am I a seller in a year?
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.